compared to the IV of out of the money options. That might be one of the reason. And also you can see at the region which we need to focus more upon, uh, focus more upon is the one over here. So this is a region which we need to focus more upon. So there is a bump predominantly for the call options. It's a pretty interesting. Either the IVs of call options of across these regions is very high. That means the call option premium is very high, and the time value is very high. Or might be the demand is very high. Maybe the 321. So either we can take it in two senses. Either the people are shorting it predominantly because that is one thing. So 321, and you can see there is a downward sloping here. So uh, it looks a pretty interesting thing because uh, we never know what's going to happen, but this study somewhat show the implied volatility is predominantly useful in signifying what is the demand for that option. So the IIV signifies the demand is more. So in the same way, this strikes the 321 strike, the demand is pretty more. So which is an out of the money call option. So let's see, it can be signified in two ways. Either people are betting on upside move, or it can be on the downside move. Okay, now coming to the other features of this options. There's a lot of options here, so pretty confusing thing. So and there seems to be a glitch in the software too, so it's pretty tough to select an option very soon. So this is the gamma. This is the gamma across strike. So what gamma tells how soon the option price, how soon the delta will change. So the gamma of 321 is somewhere around at the peak 0.08. The rest of the things are very clear. The reason is, since we are very close to the expiry, the near term options are having a very high gamma. So the $1 option can be a $10 if the stock moves down to 10. So that's the reason the gamma is very much on the higher side. And coming to the Vega seems to be pretty constant across strikes, and in the same way we are seeing a bump at the strikes, but it seems to be very steady, so nothing can be signified here. So there are a lot of things here, but let's see one of the important things, which is nothing but the theoretical price. uh, uh, Out of the money options, the theoretical price is something which tells where exactly our premium should be. So uh, yeah, the theoretical price seems to be uh, very biased towards the downturns, because you can see here the theoretical price of the put options are predominantly higher when compared to the theoretical price of the call options. So that's where we see in the extrinsic value too. The extrinsic value is also higher, and so these are all the things. It looks like downward biased, but since it's a low volume day, we can't take anything. So granted. So let's see. So thanks for watching. Let's see in the next session. Thank you.